it's a wonderful partnership that we have with Deakin University that's been operating for nearly 3 years now at lots of different levels, one of those being the Community Bank. It's, we believe, a first of its kind anywhere in the world, or the former VC of Deakin certainly used to say that on a regular basis, but it certainly hasn't happened anywhere in Australia before, excuse me, where a bank has joined partners with a university to provide banking services, excuse me, whereby the profits from your banking are going back into the university community. So just by doing something as simple as that, your university benefits. And so this is part of the broader community bank model, which has been in existence for over 20 years at Bendigo, where we support more than 300 communities around Australia and have given back over $200 million to those communities. So it's a wonderful model that's now being tested in a university, and we're very proud of what it's been able to achieve so far. This year we believe we'll give out in excess of $150,000 back to the community, and next year we think it'll be in excess of $200,000. So please, if you haven't had a chance already, grab a postcard. We've got some business cards for our manager there. We've got some Bendigo Bank staff here today. If you want to talk to us about our consumer business or our business banking opportunities, we can help you with any of those. So we look forward to hopefully seeing more business coming our way, which will mean more money coming back to the Deakin University community. But you're not here to talk to me or listen to me too often, so I'm going to throw now to introducing our partners. We're going to come up to the stage and talk to you around what's happening in the property market. And I know everybody's got their own thoughts and ideas on what's going on with interest rates and what's going on with the economy and what that looks like for the property market. So without any further ado, I'll introduce you to today's panel. We've got Chris Ratcliffe. Chris, could you just step up to the stage, please? Chris is the Head of Economic and Market Research. Sorry, Chris is a Senior Lecturer at Deakin. You just moved to Bendigo Bank, Chris, just about then. The Senior Lecturer at... we couldn't afford you. Senior Lecturer at Deakin Business School. Christopher's research areas include real estate finance, real estate investment trusts, mergers, acquisitions and corporate finance, and he's up from the Warrnambool campus today, so thanks, Chris. And David Robertson, who does work at the bank, because I've known David for a while. He's the Head of Economic and Market Research at Bendigo Bank. He's also had senior roles in Treasury and Financial Markets for the State Bank of New South Wales, First Chicago and the Commonwealth Bank. So we're going to turn on our microphones and hope that technology works. So I'll just jump in here. Can you hear me? Oh, yeah.
Testing.
It's a bit loud. So what we're going to do is obviously throw to you for a range of questions as we move on, but I thought I'll just get us warmed up. And I'm not sure if you guys have been given a heads up on these questions. I'm hoping not. It'd be nice to catch you off guard this morning. So I'm happy for anyone to answer these, but what's happening in the Australian residential property market and what effect is it having on the local market down here in Geelong? Who wants to deal with that one first?
I'll kick off on the Australian market overall, and perhaps I can lead into the impact on the Geelong market. But what we've seen until 2 months ago is the largest fall in capital city prices on record, or certainly since World War II. And so Melbourne's fall from its peak to trough fall of roughly 12% over about 18 months or so, and Sydney's fall of 15% peak to trough is unprecedented. And so if you look at the 8 capital city average or index, that it's never fallen as far, just over that shorter period of time. However, since then, or since probably 2 or 3 months ago, we've had the combined impact of the 2 rate cuts from the Reserve Bank, the tax cuts, and also, irrespective of whether you lean to the left or the right politically, I think the housing market collectively took a bit of a sigh of relief that there were no changes coming to negative gearing or to capital gains tax. And so, having just had the largest fall since World War II, last month, I think we had one of the largest rises just in the month of August. So that's the backdrop for the national markets, and obviously capital cities are a large part of that. But as for the impact on the Geelong market, I've got some thoughts, but maybe we'll share that round.
Yeah, which reminds me, last time we had a session like this was, I think, the day before the election, and ALP was about $1.10 favourite or something, and there was concerns over negative gearing and impacts and the likes, and how that turned out, which was quite interesting, wasn't it? I think you might have loaded up at the time. We won't go there.
No comment.
No. Chris?
Just to add to that, obviously the stability that came from the federal election made a big difference to the property market. There has been a lot of discussion about the fall that we have seen both nationally and sort of more regionally, but we still need to remember that prior to that we had such a long period of growth and some of the strongest growth we've seen in the property markets, both not just regional, but also in the capital cities as well. So there is a bit of, we always expect some type of retracement in markets, whether it be the property market, share market, currency market. You've got to expect some type of retracement. So it's not all doom and gloom that the media seems to want to paint that picture. They're very quick to get on the front foot about clearance rates or vendors' discounts. But just recently, as we were saying, the core index from CoreLogic, the hedonic index, that's risen again for the next, that's 2 quarters in a row that we've seen growth. So I think that stability has come back into the market. For the Geelong area, or for the greater Geelong area, they've also experienced some downturn, a retracement in the market. But again, prior to that, we saw very good growth. Regional Victoria, over the last 5 years, is still up something, like just under the 20% growth mark. So if you invest, if you're thinking that from an investor's point of view, and property is a long-term investment, I'm sure you all know you're not going to enter into the property market trying to make a quick capital gain over 1 year. You really got to be looking at that 10-year time frame, and sort of just sitting and waiting, well, not sitting and waiting, but being prepared to take time to get that capital appreciation is important. So for Geelong, I think things are looking okay at the moment. Good supply, and good entry level. There's a lot of opportunities to get into the market in the greater Geelong area. A lot of land development, which is good. So I think it's a positive.
So what about somebody who's thinking of either getting into the market for the first time now? Some young alumni here today who are probably thinking about buying their first property or investment property. Is now a good time, or what are your thoughts on that?
Yesterday was always the best time to enter the property market, in my view. It's a long-term investment. Ballarat, Geelong, Wodonga, Bendigo to a small extent, they're all in a really good spot at the moment for that first home buyer or that first investor, because the entry prices are quite good, and the rental differential between what they're getting in Melbourne and what they're getting in places like this isn't as large as the price differential. So you're getting a good rental yield. And with a bit of savvy investment or good research, it's not unusual to find a rental property in the regional centres of Victoria that provide positive gearing. So you're not negatively geared. Your cash flow from your rent is covering those interest costs. And for anyone who's looking to get into the property market, that's probably one of the first things you need to look at is your cash flow.
And just adding to that, and I agree, the best time to buy property is in the past, but if we actually look at the 5-year returns, and again, look at Melbourne, yes, it fell 12%, but still up 20% over the last 5 years. For Greater Geelong, and it actually varies a bit by postcode 3220, up 45%, I think, over 5 years, so some incredible returns. But in terms of the first homeowners activity, that's really been increasing over the last few years. And I think we just got some housing finance numbers out yesterday, a sharp rebound for owner, occupier and investor, but the part that had the largest rise was first owner. So appropriately and pleasing to see, that's where a lot of the demand's coming from, and it remains a great time to be getting into property. I would argue, despite the fact that Geelong's come so far over 5 years, when you consider that we've got a 1% cash rate, and it's pretty likely we're going to be down at 0.5% at some stage next year. So, you know, the gearing when interest rates are low makes sense.
So there's only downside on the interest rate outlook for the short to medium term from where you're sitting?
Yeah, look, I mean, the 10-year bond, so that's basically an estimate from the market as to where interest rates are going to average for the next 10 years, is at 0.9%. So it's remarkable. And you know, that doesn't mean the market's right. Who knows, 5 years down the track, there might be some surge in inflation and interest rates have to go up, but it just looks like a really long, steady period of low inflation and low interest rates. And that's difficult for savers and you know, retirees trying to live off interest. That's challenging. But as it happens specifically for housing and for, you know, considering on the other side of the ledger, I'd have to say we're facing at least 4 or 5 years of low interest rates, and the market's saying 10 years. I'll stop at 4 or 5, but you know, that's clearly going to have an impact on the ability to borrow and on asset pricing.
So no need to rush out there and fix your rate.
Well, but the fixed rates are pretty cheap too.
Yeah. Okay. All right. What about Geelong v Melbourne? That's an interesting comparison. Sounds like from a rental perspective, a rental yield, Geelong's favourable. But if someone, you know, is looking to enter the market, what would you advise them over those two areas?
Well, so my view is, and again, you mentioned rental yields. I think the average rental yield in Melbourne's running about 3.5%. It varies again a bit postcode by postcode, but seems to be closer to 4% in Greater Geelong. So there's a nice return. If you just look at the average price of a house for Melbourne, it's $650,000. For Geelong, it's not far off $650,000 now as well. Although again, a fair amount of variance. Again, postcode 3220, I think it's $750,000, whereas postcodes 3214 through to 3219. The average price is closer to about $630,000 through to $650,000. So there's actually not a big difference in the outright price, but it is a better rental return.
Yeah.
Sorry. Yeah, just to add to that, a lot of what we're seeing with the median price with Geelong, a lot of it is being driven by inner Geelong, so the established communities or the established suburbs. But if you're prepared to, and the infrastructure's there, if you look out towards Armstrong Creek and all the land area that we've got down that way towards the coast, there's still a lot of good opportunities in there for people to get in. There is there is a bit of a move. We're seeing more and more now where people are purchasing investment properties closer to the coast and using them almost specifically as Airbnb type of accommodation to try and get that little bit higher rental yield. So there's going to be that demand within the market as well. But within Geelong itself, within sort of the great area of Geelong, I think their biggest threat is basically coming from Werribee, or from the Wyndham Shire, as Melbourne moves and creeps further and further towards along that corridor. That's going to be a little bit of competition for those suburbs north of Geelong. So heading out towards, up towards Wyndham. That's probably one of the biggest challenges I see for the Geelong property market, is trying to compete. But it could be an advantage. It might be a threat, but it's also an opportunity, because eventually you would expect that they're going to join. And then places like Lara might actually start to see even more improvement in growth, especially if infrastructure spending, the promise of the fast train. Well, we'll see. But if those sort of opportunity, those type of spending does come in and that type of infrastructure does come along, it's going to be very beneficial.
So what about the impact of businesses moving to Geelong? We're seeing a lot more businesses move their head offices to Geelong. We're seeing a changing skyline here. It was only a few years ago that it was, if you had a 3-storey building, it was as high as the town went, and now it's a very different skyline. Has that any impact on prices?
Definitely. I I look back at the experiment that the ATO did quite a few years ago, where they moved their head office to Albury, and the impact that had on the Albury market was quite stagnant, late 90s, and because there's so much land. But just bringing in a government agency, so I know the Australian Bureau of Statistics, they've also moved to Geelong. And I think if we start seeing more and more decentralisation of those types of businesses and government agencies, I think that does really good for local economies, because it brings them in, but they need an accountant, they need a Bendigo bank, they need to do shopping, their kids need to go to school. It all develops further and further from there. So I think Geelong is in a very good position that they can attract that infrastructure and those businesses. And I think Geelong have done very well. When you look at like the Ford factory closing down, I remember when that happened, it was all doom and gloom that the Geelong market was gone. But it's bounced back, it's retooled itself, it's attracted these businesses, and it's doing, and that's can only be a positive thing.
And just on the jobs market, and obviously that flows through to business and the employment market. Population growth, I think, is a key input. Victoria's population growth rate 2%. That's the highest of any state, but Greater Geelong's population growth rate, I think it's been closer to 3.5%. So that's a really good thing to have strong population growth, but as you hinted before, you need to have infrastructure investment to match that. So the fast train, great. What are they? They're building a tunnel near the West Gate, aren't they? Not sure how long that's going to take. But great that we've got a state government that has a AAA credit rating, so they can leverage that to invest in infrastructure. And the City of Greater Geelong is also running a budget surplus, so need to plough as much of that as possible into infrastructure.
All right. Well, we might take this opportunity to ask some questions from the crowd. I'm sure there's a lot of people who've got some questions to ask, and if they haven't, I'll point some out. So be aware. Rod, you should get pretty nervous if all right. Anybody out there who'd like to ask some questions from the people up the back there?
I'll make a couple of comments around interest rates, and for mine, it is an entirely different world today, given we've got inflation down at 1.4%, or for core inflation, I think 1.5% headline CPI. The fact that if we go back to 1989, when the cash rate got to 18%. But inflation, I think, back then was persistently too high. I think it was up around 5 or 6% from memory. So I think if we're worried about what might turn the interest rate outlook round, and I suspect it's going to take a long time, it will be, the main thing to look at will be inflation. And while we're below 2%, so the Reserve Bank have got a target band of 2 to 3%, so they'd like it to be closer to 2.5%. But until we even get to 2%, which looks like that's still a couple of years away, I don't think we should be fearing higher interest rates. The Reserve Bank talk about spare capacity in the jobs market. They estimate that until the unemployment rate gets down to about 4.5%, you're not going to see much wages growth pressure coming through. And so therefore, as well as looking at the inflation rate, I think we need to look at the unemployment rate. And it would only be if unemployment suddenly fell below, say, 4.5%, that therefore we might start expecting wages growth and therefore inflation. So that'd be the two bellwethers that I'd call out.
It seems, Robbo, that monetary policy is getting more and more difficult as a tool to use with rates so low. So on the fiscal front, do we expect more change?
Yeah, and that's what we've been arguing to the extent that a bank should argue or suggest to the federal government. But we're certainly of the view that fiscal policy is what will really make a difference now. Monetary policy, whether or not the cash rate's at 1% or 3/4 or a half, I'm not sure will have a material impact. Great to see the recent tax cuts that the government unveiled, but I'd argue we need a lot more, around not just tax cuts but infrastructure investment. The government have got a reasonable free kick with the iron ore price up at $90 a tonne. There's only budgeted to be 55 in the budget.
Okay.
I'd love to see them spending as much of that as possible on fiscal policy, mainly infrastructure.
I think also on top of that, we also need to look globally. Australia is a follower when it comes to the global markets. We're not a leader. We have to accept that. And while we still have the situations like we have with the US and China, I can't see a lot of growth coming our way until, and therefore pressure on interest rates. So it's another thing that I would keep an eye on as well. If the American economy, and then you've got the UK with their no Brexit, hard Brexit, whatever they end up with. With all that uncertainty worldwide, I think there are advantages for Australia itself, because even though we are a follower in those markets, we can get some leverage out of those. Like like you talk about iron ore, you're talking about our exports. You look at the last GDP figures, our net exports were up a large amount, and that actually sort of stopped made basically us to have some positive growth. If we start seeing a turnaround in resources with the current global economy, then I'm going to start getting nervous.
Yeah.
If resources turn and start going south, given what's happening with China, US, UK, there could be a little bit of uncertainty coming. It probably is not going to impact interest rates, but it's going to have a big impact on unemployment and wages growth.
China being still our major trading partner?
A third of our exports go to China, so it's easily our largest trading partner. And we need to walk this fine line between our largest trading partner in China and our largest security partner in the US. So that's a pretty interesting line to walk.
It sure is. And we mentioned last time, there's some governments running with negative interest rates in the world, and I wasn't aware of that until we spoke last time. That you invest in a bond and you'll get less than your principal when it expires. And
there's roughly $20 trillion worth of bonds trading in the world with a negative yield. But keep in mind, that's not mums and dads investors. No. So even in Germany and Japan, where you've got negative interest rates, you still get 0 or maybe 0.1 for your deposit, and you're still paying maybe, say, 1% for your mortgage. So even though the bond rates, which are really for the professional market and for banks investing with government, is negative, that's sort of a stranger things upside down world. We'd still live in a positive interest rate regime, even if the Reserve Bank went to minus a quarter.
Okay.
Which I don't think they will.
Yeah, because they certainly need to be fiscally active, aren't they, before we get there. All right, there was a few more hands up. Try again, please.
What about the commercial industrial market in Geelong? I seem to see a lot of factoriettes bobbing up and new shopping centres. What's the investment like on that?
Do you want to go first?
No,
Okay, I don't have a specific comment on Geelong commercial property investment versus resi, other than to note that for the last 18 months, commercial's been outperforming resi. Will it continue to? I think it'll probably go right again. It will continue to have a reasonable run thanks to low interest rates and a pretty robust jobs market with unemployment down at 5%. But we need businesses to be continuing to invest, so capital expenditure needs to pick up. So my comments are really on a national level rather than specifically for Geelong.
One area with commercial, when you have good population growth and low unemployment, the commercial property market always seems to do quite well. My one alarm bell is retail. That's one area that's causing me, well, not causing me, but I have some concerns about retail. Retail spending is, sort of very, very low. Consumer confidence is quite low, and that can have an impact. So there's two parts to that commercial side. There is your commercial, which is your working, such as businesses and things like that, and then there's the retail component. That retail component is really suffering, and I'm not too sure about Geelong's retail market. Walking around, few empty shops. I can, going from the Warrnambool point of view, our retail is very, very bad at the moment. Our main street's half empty, really. It's been topped up with a few things here and there, and that's causing a bit of problem. But on the commercial side, we still seem to be getting good rents on top of that. So it's interesting. So there's no consumer confidence in the retail area, but there's still employment and population growth. So that commercial type of leasing is doing quite well.
Steve, we've got Steve Davis here, our head of business banking in Geelong. Have we seen any significant activity in the commercial space here in recent times?
I'd probably add to what the guy said. I think.
Sorry, Steve, to put you on the spot, but no such thing as a free breakfast.
This
no.
wasn't
No.
planned, by the way. Add to what the guy said. I think it is, from, I guess, it's certainly levelled out. And a lot of that, I guess, prior to the election, it was very conservative. People were waiting to see what was happening. Since then, people have got on with business,
Yep.
and I think that's important. Life goes on and business goes on. I'd certainly say that retail, pretty tough. Commercial, there's still activity, but it's not hectic by any means. But I guess good businesses are good businesses, and that's what we continue to look for and support them. And if it's going to their own property, us being able to support, it's pretty good. With low interest rates, it's the guys have mentioned, you've got to measure that up against rent. What sort of deposit do you need to put in to assist? I guess the smaller factory type things are probably becoming less popular, maybe. But it's probably reasonably subdued. But life goes on, I guess. So,
All right. Any other questions? Up the back left.
Is negative gearing sustainable, and can we expect future governments to have a crack at it?
Well, I've got a view, but you go first.
I'll walk into it.
Yeah.
It'll be the death knell of the government. I really think if we've just seen in the last election, they were unbackable favourites, but outward we're very sort of socialist and everything, but I think when we vote Conservative. So I think with that negative gearing, especially when people start thinking about self-funded, funding their retirement. If you lose one of those investment options, it really does make it difficult for you to, achieve that self-funded retirement. So personally, I think it would be very difficult for a government to actually do it. I think we might see some adjustments to it. So it might be, sort of limited to a value. So they probably could put a ceiling on it. That's one possibility. But at this stage, right now, I don't think any government or opposition is game to go anywhere near it.
So I've got a view on the sustainability, and I think in its current form and with how the property market's performed, it is too generous a break. Now, I think what the challenge that Labor ended up saying was, they were trying to go from here to there. And I agree with your comment around means testing and ceilings and so on. To me, there needs to be a relaxing of the tax incentive rather than just a removing of it. Maybe for our economy, it depends a bit on how the resources sector goes. If that continues to go gangbusters, then the government can afford to continue to provide more tax breaks. But it's a pretty generous deal. Well, my personal view would be the only way to achieve change there would be to inch towards it rather than a quantum leap. And the quantum leap, the voters very directly rejected.
And I think at the last election, we're talking about grandfathering existing arrangements, weren't we, as well,
Yeah.
which is important for people to know. Would you expect that to be the case regardless?
Well, yeah,
Yeah.
that's a minimum.
I mean, it just,
It was actually
for those,
surprising.
there was a bit of anxiety around that. I know, last time.
It was actually quite surprising. We all knew it was going to be grandfathered, but we didn't see a run on investment properties. I sort of thought there might have been a little bit of a mini run on investment properties, but maybe there's that uncertainty about what's going to happen to my my franking credits as well. So, is it sustainable? Not. I totally agree. Not at this stage in the current form. 25% discount. I think that is sustainable.
All right. More questions?
I know this is a seminar on property or a discussion on property, but I'm one of those self-funded retirees, ex-alumni and staff member here. Do any of you have any comments on the comparison between putting any excess money I would have, for instance, in the property market versus more shares?
Yep.
Now, given that shares are trading at probably 5, 6, 7, up to 10%, UniSuper's doing really well. And you talk about property bringing in about 3%. There's a bit of a difference there, but there's also an age difference for somebody like me, for instance. So any comments about that?
Yeah. So, I mean, my comment would be certainly the closer we get to a 0% interest rate, the more, I won't say the Reserve Bank's doing it, but the more one is encouraged to go into riskier assets, because you can't live off term deposits when they're paying 1.5%. So what should what is a sensible investment choice? Well, I've always argued a diversified approach. So, roughly a third into shares, a third into property, a third in cash would be a simple diversified allocation. The property side, how can you actually get that exposure to property as opposed to, there's obviously, you can buy a house, but it depends how much you've got to invest. Real estate, investment trusts, and we were just talking about commercial property before, they're mainly invested in commercial property rather than residential, but they're one way of getting access to or exposure to the property market. And shares, yep, you pick some nice blue chip stocks with a nice dividend yield, and Bendigo Bank would be amongst them. You'll be getting, close to 4 or 5%. So that's a lot better than 1% on cash. But again, being in, if it's retirement funds, the downside of shares is they can go down. And in fact, they look pretty expensive to me at this stage. They go up over time. So if it's anything more than a 8-year time horizon, you've got to be in shares, a portion. But if you're only looking at a shorter time horizon, then it starts to get a bit more problematic. So that would be the asset allocation, I'd argue. But
obviously, yeah, with your superannuation, there is a push towards self-funded retirement. Not many of us are going to have, well, by the time I retire, there'll be no opportunity for me to get any government assistance, and I accept that that's going to be the case. And yes, it is, we were talking about 3% yields, but that's the rental yield. You've still got to include the capital growth on top of that. So yes, the share market might be sort of going 5, 6. We've had a good run recently as well, up around 8, 9, 10. But the capital growth side that you can get out of the property market is also quite good. So don't forget that one. Also, obviously, as we get older and older, we want to be more conservative in our investment because we want to preserve as much capital as possible, because when we stop working, that's when we consume the capital. So the good thing about an investment property as part of your retirement is that if you are able to own that outright by the time you retire, your investment property, and it's paying $1,000 a week in rent, well, that's $1,000 a week, $1,000 a month, I probably should say.
It's a big property.
Different, yeah. I was back in the Sydney market, sorry. But if you're achieving $1,000 a month out of that rental property, that's income coming in, which is going to be higher than what you're going to be getting out of fixed interest.
Yep.
And there's still security. All right, you might have vacancy for 2 months of the year, but you can factor that into your numbers. So there is a very good place for a property investment for a retiree.
Hi, my question is more Geelong-centric. So I'm interested in two parts. We've talked about the median house prices in Geelong and Greater Geelong. How has that impacted on Bendigo Bank's lending in the last few months in real time? So what sort of lending are we doing, the lower end market or the higher end market, and what the lending has been? And also we've heard some talk about how recently it's harder for young home buyers to get into the property market and restrictions on their lending. How has that affected with you?
Well, that's definitely not my area.
Yeah, well, so I mean, on behalf of the bank, I can make the comment and the observation that we are active lending to all parts of the market. So it's not as though we're targeting any particular area. We've got a customer-centric but business model. Our purpose, our vision is to make our customers and the communities they live in more prosperous. So it's not about us choosing a particular market. And from the numbers I've been seeing, it's been relatively strong demand across the board. The other observation I'd make, we had our full year profit results out the other day, and I was just looking at some of the slides there, and I saw that the arrears rates have actually come down in the last 6 to 12 months in each state. Now that doesn't drill down by postcode, but good to see that lower interest rates as they're playing out are actually, despite again the media hype around struggling property markets, the arrears rates are actually performing very strongly. So, and you mentioned first homeowners. Again, there's been a large increase in activity in first homeowner buying, given the a lot of the breaks through state governments now. They're getting rid of the stamp duty concession. So, I think it's actually, and I appreciate that in a rising property market, it's hard for a first homeowner to get in, which is why it's sort of been good that we had a bit of a bear market for property, but good to see some of those concessions coming through for first homeowners, and the numbers suggest there's more first homeowner activity rather than less. Okay, and so the regulator did come in a few years ago and make it, and basically told the banks to do less interest-only lending and less investor lending, and they basically enforced differential pricing. About 3 years ago, it was the same interest rate irrespective. Now it is a higher interest rate for interest-only or for investor versus owner-occupier. But the owner-occupier rates are the cheapest. Yep. Which is good. And it was good to see the regulator come in only 3 months ago and get rid of what they call their serviceability floor of 7%. So prior to that, we as a bank, and any bank, had to assume or had to sort of model that, can this borrower cope if interest rates go to 7%? Now, that's a ridiculous assumption when interest rates are 1%, or when the cash rate is. So I'm glad they've got rid of that rule. There are a few factors I think which are helping first homeowners, but it's still tough to get the deposit, and I know that because I've got 3 kids who are all trying to do that.
The guarantee mortgages that are seeming to be there for top-ups for loans, that seems to be becoming more prevalent from my general observation.
Right. Yeah, I'm not sure.
No, I haven't seen much on that, but I do know that from a consumer perspective, Bendigo outgrew systems growth last year. So if you compare that to what, on average, the other banks are doing, we were doing more lending based on our size than the other banks were. And certainly through the Deakin University Community Bank, we've done a number of loans for students, whether they be personal credit cards, personal loans, or even home loans as well. So the challenge is often raising the deposit more than the serviceability, because as we said, rates are so low, and sometimes the bank and mum and dad can help with that. there's ways we can help with that.
Probably add, even though my expertise is more in the business lending, I guess, but the criteria around the regulatory body looking at what you're spending in the past, I guess when you went for a home loan, we looked at what you earned, but not so much what you spend. And now there's a very close focus on both.
Mm.
So that's something that's certainly changed. So, so if you apply for a loan, you'll need to tell us what your living expenses are, and you'll need to justify that by ticking them off basically against your bank statement. So that probably that's come into force.
Yep.
But,
And that's all post GFC. There's concerns about credit being too easy, and what does that do? And it's just creating, you know, a debt world that's unsustainable. You know, you used to be able to get, you know, a letter in the mail to increase your credit card limit. You know, it's a lot harder to do that now.
a lot of that's about the responsible lending and
Correct.
commission and that sort of thing. But I guess we mentioned earlier, it's a good transaction. You know, we love to support it. So.
All right.
Did you see the government injecting that for guaranteeing the 15%, excuse me, 15% deposit coming into play soon, and how does that work?
That's the first homeowner scheme?
Yeah. So that's that 20 instead of the 80% LVR.
That's right. They were going to guarantee that, so you don't need lender's mortgage insurance as a first homeowner.
It'll be an expensive.
Are they actually topping it up, or is it just the guarantee?
They're taking the risk.
They're taking on the risk, so the bank doesn't have to take on the risk or ask you to take on the mortgage insurance.
Yeah.
Should allow 10,000 first-home buyers to get in the market a lot easier.
Yeah, I remember when that came up. I think it only came up the week before the election, and it just looked like a bit of a thought bubble. And I haven't actually heard a lot about it since. I mean, anything that helps first homeowners, I think, is a good idea. There's already the scheme through Super. You can access your Super scheme for some of your first deposit. Not that there's been any great take-up of that rule. So my only question was, is that scheme that's been proposed, is it broad enough? Will it get sufficient take-up? And do they need to broaden it further for it to actually have a meaningful impact on the market? But anything that helps in that respect is a good thing. I think they might need to go harder, and the harder they go, the more it'll cost them. Yep.
All right. Yes, on here.
Just being a younger member of the alumni and a current student, is there anything that you did that you regret, or
How long have we got?
except for me, or anything that you didn't do that you would recommend doing, sort of in terms of investment property and super and things like that?
Oh, I'm glad you clarified that last bit.
So I'll use my personal experience. So I remember a very wise man saying to me, he was a mate of my father's actually, way back when I was 20, I don't know what it was, 22, saying, and he was pointing out just how cheap property was then, and I was living in Adelaide at the time, and it's a suburb. I can't remember exactly where it was, but a house would have cost about $120,000. And I remember thinking at the time, well, that's a lot of money for a house. And, you know, it'd now be worth whatever. You probably add a zero to it. So the challenge back then was, all right, how do you raise enough deposits so that you can get in there? But I very quickly dismissed this idea of, as opposed to a house to live in, and you scrape together what you can, this whole concept of investment property or just benefiting from the fact that over time property prices increase. And I've got no doubt that property prices will continue to increase, and it remains a very sound investment. There'll be ups and downs, there'll be huge swings and roundabouts, but all I can say is I regret not listening to this chap saying, wow, that's cheap, and me thinking, oh, I don't reckon it's that cheap. No, it was cheap. So, you know, that's the time value of money, and the value of compounding over time. Even something that's compounding at 3-4%, look at that over 30 years, and it is a massive increase. So listen to wise people suggesting that things are cheap would be my advice.
Oh, boy, that's a hard question. I think probably the easiest way for me to actually explain that one is, yeah, I wish I had got into investment a lot earlier, but disposable income also is, you know, a major part of it. Using our hindsight, actually, my wife and I went part share with my daughter in an investment property in Warrnambool. I mean, she lives in Perth, but she wanted to. She's 22 years of age, and she wanted to get into the property market because she'd seen, you know, what we were doing, and yeah, she's really benefiting from that. But the good what she did was, it wasn't, oh, you know, it need to be in Perth, or I want to be in Melbourne, I want to be able to see my property or anything like that. We went regional. So that's probably some of the best advice I can give you. You know, don't just look Geelong, Melbourne, Ballarat. Look regional. There's still people. The rental vacancy market in Warrnambool is one of the lowest Australia-wide. So rents are very good down there, but property values, we've only had 1% capital growth per annum over the last 5 years. So as a property owner, that hurts a bit, but the rental yields are absolutely fantastic. So what I would say is look regional, and yeah, property is always a good investment, but remember it has to be minimum 10 years with those type of investments to get the full benefits.
What about, we're talking about units versus, you know, homes, and especially the Melbourne market and the density of the units there. What are our thoughts on the two from an investment perspective?
Yeah, I was going to say, you know, I've quoted a number of percentages around houses, but the unit market has been, you know, not as meteoric in its rise, but nor as dramatic in its fall. But for mine, with population growth, there's going to be more demand for units because there's just not as many houses being built. So it's less of an aggressive play in that it's going to have steadier returns, in my opinion, but there'll be demand. So you know, it's like a slightly watered down version of the detached dwelling market.
And I mean, obviously entry price is a lot less, so you get that opportunity to get in. One advantage for people looking towards the units at the moment is we have an oversupply Australia-wide, which is holding prices down. So eventually that supply will be taken up. I mean, you know, while we continue to grow at such a high rate within the capital cities, they've got to live somewhere. And eventually that excess supply of these units will, as long as they all get fixed, will get taken up. You only have to go overseas. You know, you look at some places like Santiago in Chile. It's just high rises everywhere. All right, very, very little amount of housing until you get further out. And those units have been around for 15, 30 years. But when they first started coming on the market, it was the same as what we're seeing here. There was a massive oversupply. No one wanted them. But now everyone wants to live closer to the city. So there's great opportunities. You get this construction cycle. And so what happens is we're getting this lag in the construction cycle where there was a peak in demand for units, so all of a sudden you're getting a lot of construction going on in the unit market, but because that supply takes so long to come on and the demand can quickly disappear or go elsewhere, we see a change in the market and things like that, all of a sudden we have this excess supply. So it'll take a little while, but it's probably a good, you're getting near good opportunities to get into the market in that unit area.
The other factor with all of that, I think, is technology, and this is the part where it's really hard to actually make a call as to what it's going to look like in 15 to 20 years. But I think when technological disruptors were coming along, we were thinking that would encourage dispersion, and if anything, it's encouraging centralisation. And again, I think that goes to the unit, palatability. So
consider a unit as well as a home when you're looking at, whether that be in the regional areas or unit in CBD. That's well worth considering. All right. We've only got a couple of minutes left before we wind up. Is there any other questions that anybody want to ask? Please, Leanne.
Just coming back to interest rates with the negative interest rates, why would somebody invest, a big corporate or whatever, invest in to get negative return? Why would you do that?
Yes, good question. And the reason there is so much, so there's about $80 trillion, I think, $54 trillion worth of bonds around the world. And bonds are basically these things that superannuation managers and fund managers invest in. Or that's part of their portfolio. So why would they put any of that into a negative yielding bond? Because part of their mandate is to have AAA. They've got to have a certain percentage of their funds in AAA rated investments. And most of the AAA rated investments nowadays are trading with a negative yield. So if you're a fund manager, you've got 10 billion you've got to invest, 20% of it's got to go into AAA, there's 2 billion that's got to go into AAA, and you've got no choice but negative yielding bonds. So that's the only reason that people are going into it. Basically, it's akin to saying, I would rather take a small hit on my long-term investment than put it in something riskier and maybe getting nothing back. So it is a strange choice, if you like. But you can see why fund managers do need a portion of their funds in AAA rated, almost risk-free assets. So risk-free is coming with a cost now.
Risk-free has a premium, doesn't it? First in my life that we've ever seen that. So
absolutely.
Quite incredible. All right.
One for the road?
Yeah.
Just curious if you have any views on the long-term viability of short-term accommodation platforms like Airbnb, stays, things like that, particularly from an income perspective, long-term. How would they compare to, say, an investment in a commercial or residential property?
It's an interesting one. Take a look at Hobart. The rental market down there, it looks like there's hardly any activity, but it's actually really big in Airbnb. There's actually quite a lot of supply down there in the Airbnb market, and I think we'll start to see that in the more tourist areas, along the coast, inside Melbourne, things like that. There's a lot of volatility, so you're taking on a lot of risk. If we start to see more and more of this share accommodation, and the legislation becomes tighter and tighter, then the pricing, I think, will become less. So there'll be less opportunities to make those good yields. In the long term, I think the biggest threat for these types of accommodation is going to be legislation. So what happens from the government putting in place rights and responsibilities and stricter conditions, and that will flow on into the banks, which will then start to look at these things in more detail as well. Because I'm speaking on your behalf, but I couldn't imagine the loan manager sitting there looking through your income and you're going, well, I'm going to Airbnb this place for $10,000 a year. It's just like, well, that's not an income. They're not going to consider it. So that could be an issue. But 10 years ago, who would have thought I could get a McDonald's coffee brought to my door? Yeah, I could be wrong.
I agree. There's uncertainty, legislative uncertainty. This comes back to my comment around technology disruptors. What a great disruptor that was. Well, not so good if you're competing with hotels and so on. But what's going to be the next disruptor? So what's going to disrupt that market? Driverless cars are likely to disrupt Uber drivers who already disrupted the taxi market. So the technology risk or the technology disruption train is a challenging one to anticipate.
So just to add to that, sort of what I'd probably look at would be if it was something that's in a coastal area or a tourist area, I'd maybe look at using that Airbnb over the higher periods, but then trying to look for a normal 6-month lease, tenant in those quieter periods. That's probably the way if I was going to go down that track, but that is only my view. I'm not telling you. That would be my view. So you get some type of certainty.
All right. I think that's about time for us. So I'd like to thank David and Chris for their time this morning and their great advice. Are we going to...
Thank you very much, gentlemen, for that very interesting and insightful discussion that you've prompted there, and some very interesting questions coming from the audience. To all of our alumni here this morning, I'd like you to stay in touch with us, and we'd like to invite you to our future events. So it's very important that you update your postal address and your email address with us, so that we can keep in touch with you and invite you to events like this. So just a reminder to make sure that you touch base with one of our team that are here this morning, with Lauren, Dorian, Sam, and make sure that you update your details with us, please. For those of you considering returning to study, just a reminder that we offer alumni and their immediate family members a 15% bursary. So if you're looking at some study, please don't be shy. Come and ask us about that bursary, and we can talk about that's on all postgraduate awards commencing this year for the life cycle of the course. It's not just when you commence. So that's actually worth quite a lot of money. More information is available on the alumni website, but as I've said, please make sure that you take advantage of having the team members around here today. Okay, so thank you again to everybody this morning. Great turnout, really pleased to see you supporting this event. Thank you to our experts. Bendigo Bank, thank you for supporting these events. Please stay and have more drinks, something to eat, and network with your colleagues this morning. Thank you, everybody.